Okay, so this is a website that I have a subscription to. It's called TradingView, and it has all the technical indicators. It's got a lot more than I actually use, and different people use different tools to kind of judge their trading habits. But this is the system that I've been using since early in the year. So here's a stock. This is Cloudflare. This is one that I'm currently trading, and they're called swing trades. Some stocks will find themselves in these nice rhythmic channels like you see here. So the original support was back here, and you'll see it rides that support line, and then it heads up. And as it heads up, it's going to reach a point where it's going to meet what is called resistance. And when it hits resistance, it could go straight through, but in general, it's going to move it back down. This is an indication that the buyers are losing interest and the sellers will gain the upper hand, and back down she goes. A lot of times this will happen because people have made a good amount of money on this rise and they just want to take some profits out and move profits to other investments that they think are more promising, and that's exactly what I do. So what we do actually contributes to this, and that's one of the reasons that it works. Is everybody kind of gets the idea, hey, let's get out, take the profits. It moves it down, and then people start getting out. They don't want to get, it's FOMO, right? They don't want to get left holding the bag, and so down it goes. And at some point, the price becomes too attractive to ignore, and the buyers step back in, like myself or you. So at this point, the buyers step back in, and the price starts rising again. On this particular day, the high for the day has touched that same resistance channel, and back down she's going to go. So she drifts down, but she doesn't quite make it back down to support, which is fine. Makes it back up to resistance, holds at resistance. The sellers step in, and it goes down, and boom, back she goes to the resistance line. And at this point, it's kind of a duplication of what happened here. The buyers are taking profits, and everybody becomes a seller, and down she goes. But as you notice here, it meets that support line, and now it's hovering, but it's pretty obvious that it wants to move back up, and it probably will. Now, if this stock penetrates that line, you get out. No matter what, you get out because the channel or the pattern has been broken. So this is one of those examples where you have to be pretty disciplined, because if it drops down and you go, oh, no, it's going to come back, you're emotional and you're going to lose money. So if you have lost, a couple $100, or in my case, it might be a couple $1,000, but it moves down below this line, there is no good reason to stay in that option. But as long as it keeps moving up, and there's not a better place for your money, you stay in this stock until it gets close to resistance, and I'll talk about that in a second. So this line is the 50-day moving average. It's a rolling average, so the stock price is remaining above the 50-day moving average. The blue line is the 200-day moving average. So usually I only invest or bother to deal with stocks that are above both the 200-day moving average and the 50-day moving average. That indicates that that stock is in an uptrend, a substantial uptrend. So as long as it stays above, first of all, as long as it stays above the support line that I've established, and it stays above the 50-day moving average, it's worth considering. But if it penetrates either the bottom of the channel or the 50-day moving average, it's out. I even take it off my list that's over here to the right. I don't even consider it. So that's one thing. These E's are earnings dates. That's the date that that company is scheduled to issue their earnings report. So you never really want to hold an option through the earnings date. So if the earnings is going to come out on a Thursday, you probably do not, in most cases, you don't want to hold that stock over Thursday. You want to get rid of it earlier in the week. The reason is the market is always anticipating what the earnings are going to be. So if the whispers on the street is that the earnings are going to be really good, that is going to be factored into the share price before the earnings are released. So there's really it's going to go down almost inevitably after earnings. Occasionally it may spike up, but almost inevitably, even if it spikes up, it's going to drop down below where it is before the earnings. And the reason is, if the market is correct and the earnings are really great, it's already been factored into the price. So the people that were anticipating the good earnings are going to get out because it did exactly what they thought it was, but they took that ride and they gained from making the right choice. If the earnings disappoint, it's even worse. So you're just not going to win by holding through earnings, because either the price reflects those earnings already and it goes nowhere, or worse yet, the earnings disappoint and the next day you lose your shirt because it drops incredibly fast. So that's what the E's are. So this line down here is what's called the absolute true range. So this line indicates how enthusiastic traders are about the current movement of the stock price. So if this line is really high, like up here around 4 or anywhere above 3, that indicates that, and it's a non-directional indicator. It's just indicating how convinced the market is about the current price direction. So if you're in an upswing like this, like Cloudflare is, and this line continues to go up and up and up, what that indicates is the traders are very convinced and very excited or enthusiastic about the direction in which the price is moving. Now, I'm going to show you another stock in a second and show you how that works. But ultimately, if you're in an upswing and this is a shallow, the line is down here, that means they're wishy-washy and it could turn on you at any point. If the absolute true range is rising or is high, it means whatever direction that price is going is the way Wall Street is very excited, enthused. They've bought into it. It's moving up, so it's not likely to change directions as long as this is high. This line down here is called the relative strength index, and what that's looking at is it's a momentum oscillator, which basically measures the speed and change of price movements, and it can be anything from 0 to 100. Now, this is where I tell you if a stock is above the 70 on the relative strength index, then that's considered overbought. So look up here directly above this when it was overbought, and you're going to see after it reached the overbought, it moved down, right? And it got down to here, and you see the relative strength is down a little bit, and the relative strength went back up, and here you can see it's overbought. So it just kind of continues down that path. Here it's overbought. You see how it drops. And then you get up here, overbought, right? In this range, overbought. So down she goes. And then here, it's slightly overbought. But when you're down here, and if you look down at the relative strength index, it's well below 70. So it's not overbought. Neither is it oversold. If it were below 30, that would be oversold. That's a strong buy indication. You don't have a strong buy indication here, but what you do have when you look at all these indicators together is you've got your channel, which indicates that it has met support, so it's likely to go up. You've got your absolute true range, which is saying that the current price movement is strong and that Wall Street is enthusiastic and bought into the price direction. And then you've got a state here where you're not overbought. So when you look at all those together, the likelihood is it is going to move back up. It may not move drastically or really quickly, but there's a good chance that it could, and I think that it probably will. So that's Cloudflare. So let's look at Yeti, because today I kind of called that Yeti was going to stall out on us a little bit. So similar to what you saw with Cloudflare, it's in a pretty good range. Not as many points to work off of, so it's not quite as reliable a channel, but you got support, you got resistance, you got support, you got resistance, you got support, and now you're on the upswing. Now, if you've made a pretty good profit and you get up in this area here, you got to start thinking in terms of this would be your absolute sell was when it met resistance again. But look down here. Now, it is, the market's pretty excited, but as you see, it's not a continuous up. It's kind of a flat absolute true range. So enthusiasm, yes, but not growing enthusiasm. It's a solid uptrend, but it isn't as exciting as Cloudflare. But look here. Down here, you'll see that the relative strength index has exceeded 70, and as you remember, that means an overbought condition. So overbought with a relatively flat absolute trend range indicates to me it's nearing the top of its growth. Now, it could continue to go up. Don't get me wrong. It could continue to go up, and it could meet the resistance, and in all likelihood, it's going to come back down. But if you've made, say, 20, 30, 40% profit on an options trade, and you start seeing this, and you're overbought, and the ATR is kind of flat, it's time to start thinking about taking your money and leaving the table. So let me show you a different, and this is Peloton, which you kind of brought to my attention. So let's look at this. Again, relatively good trading channel. So here's support, and here's resistance, and here's support, support again, resistance, resistance. Now the problem with this is, again, you have a relatively flat ATR, but it is relatively high, so I expect the uptrend to continue in general, but what's going to happen in the short term? This is a pretty good candidate for a put call. So if what are the ones that we do? If a call option means you're reserving the right to buy the underlying stock. So you're buying a derivative. An option is a derivative, and when you buy a call, you're buying the option to buy the stock at the strike price. So when you buy a call and you buy it down here, you're going to say, I'm willing to buy this at $120. You're hoping it'll go up to $160 because the value of your option is incredibly high, because anybody with a lot of money out there would love to buy, say, 1,000 shares of Peloton that is now selling at $167 a share for $120 a share. So when you sell them that contract, they can then convert that and combine it with a bunch of other contracts that they buy from other people. And if you're buying 10,000 shares of this, they're going to make a tremendous amount of money in one day by buying your option and then converting it into stock. So they're going to pay $120 for a stock that's worth $167. A put is the opposite. A put says that you're willing to buy the option at this price, and you're expecting the price to fall. And now you're not willing to buy the option, the underlying stock at this price. You're willing to sell, or you have the option to sell, right? So it's an options contract. You're not obligated to buy the stock, but your contract gives you the option to sell the stock at whatever the strike price is at the put. So let's say that you buy a put at $167.42, and if the pattern holds and the price goes down, and let's say it goes back down to here, because you're going to get out if it goes below. Actually, you wouldn't on a put. You would just let it ride. But if it goes down, let's say it goes to $130, what you now have is a contract that allows you to sell that stock at $167.42 when its actual value is only $130. So whoever buys that contract for you can go on the market, buy the stock for $130, turn around and sell it to whoever holds the contract for $167. So they make this huge profit here. So in this particular case, if this crosses down here and this becomes overbought, and you've met the resistance line up here, I would be buying put options contracts on this. And again, just like before, if it penetrates the resistance line, you're out. You're just out. But if it does do what I think it's going to do, probably wouldn't buy tomorrow unless it touches this line and we go to overbought. But if it does, I'll be buying put contracts and hoping the price begins to descend again. Again, I'm confident that overall price direction is going to continue up, but the short-term price, I think, is going to drop and move back down toward support as it did here and other times. So that's what a put is, and that's how I would make my decision on that. So again, your decision of when to get in and when to get out is a combination of where is it in this range, how strong is the sentiment for the stock. Remember, this is non-directional, so if this is telling you that the sentiment is high, it's high in whatever direction the stock is going. If the RSI shows that it's overbought and it's met the top of the channel into resistance, time to start buying puts and track it back down. So anyway, I'm going to stop it there. A lot to digest, but that's kind of the system. It does require some time on the computer and a little bit of experience and a little bit of gut, but the idea is to take emotion out and let the patterns and the numbers, and is it right 100% of the time? Absolutely not, but it's right often enough, and it's consistent enough if you follow it without emotion that you can make a bunch of money. All right, dude, and stay away from the earnings. Never carry an option contract over the earnings. Nothing good can come of that. All right, dude, have a good evening. We'll see what tomorrow brings. Talk to you later. Bye.